Home mortgages, how to get the best deal. In this video you will learn about the actual meaning of home mortgages, and how does it work. You will hear some words like calculating mortgage payment, refinance rates, and mortgage lenders. Don't be confused. All will be discussed in detail. Home mortgages can be defined as the process in which you apply for a loan in return for a piece of property, such as a home or any other investment property. This loan can be given by a bank, mortgage company, or any other mortgage dealer. The borrower transfers the property to the lender on the condition that it will be transferred back once the complete loan is paid by the borrower. But before you apply for the loan, make sure you know the terms of mortgage lenders and refinance rates. Mortgage lenders are the person, private or public group, who gives you the loan. It may be any financial institution. Refinance rate helps you pay off your previous loan and get the new one at new mortgage terms and rates. You can easily calculate refinance rates through any website, or your mortgage lender can tell you one. If you enjoy videos on investments, insurance, finance, loans, and mortgages, you'll love following the Money Trace channel. You can support us by hitting the subscribe button and the bell icon to be notified when we release new videos. Please also hit the like button if you find this content helpful, so that YouTube will spread our message to more people. Look for multiple lenders and options. It will be so wise of you if you are already working on that, but if not, start with these tips. Seek multiple mortgage lenders, such as 3 or more, because they are seeking business. This will be beneficial as the different mortgage lenders will offer you different mortgage rates. Thus, apply for multiple lenders and see who offers you the lowest rate. These multiple lenders can include a bank, credit union, a public mortgage lender, and a financial institute. All these lenders will give you a loan estimate to which you are eligible, which will contain the interest rate and closing cost. And they will provide you with other details that will be included in the document of the loan in the first 5 years. And the lowest mortgage rate will be better than lower closing costs for a longer loan time. Here at Money Trace, we've already done the heavy lifting and researched the best mortgage lenders for you. You can click right now on the description link below and get the best quotes. Just don't forget to come back for more important tips. Minimize the mortgage rates and closing costs. If you are in search of the best deals, mortgage rates and closing costs crucially matter. The mortgage rate, as you know, is the amount of interest the lender asked you to pay for the loan. And the closing cost is the amount you pay as a fee to the mortgage lenders and third parties. There is always a fluctuation in the mortgage rate. The short-term loans mortgage rates changes are small, but you should opt for your mortgage rate at the level you can afford and for the more extended loan period. Always go for the lower rates by keeping yourself updated about the present mortgage rate fluctuations. The same goes for the closing costs. You have to keep yourself updated. These rates affect your pockets and the overall matters of the loan, so look around for lower mortgage rates and choose the services which will cost you less closing costs. Decrease your debt and increase your equity/income. Decreasing your debt and increasing your income sounds tricky, but believe us, it is the best way to get rid of your debt. Because, firstly, it will build your credit score, and secondly, it will get your worries away by paying off your old debt and increasing your equity. This way, there are lower mortgage rates and better options for you. Cutting down your expenses is one of the best ways to get rid of your debt. Or else you can ask for a promotion at your job to get a raise. Improve your credit score. The better your credit score is, the more you are worthy of the loan. The lenders will look for more potential if you have good credit scores and consider giving you a loan without any hesitation because your credit score tells them that you can repay the debt. Also, better credit scores can get you the lowest mortgage rates. And if you want your credit score raised, try to pay off your personal and credit card bills to improve your credit score. Try to give a high down payment initially. The down payment indicates your house ownership, so try to save more for a down payment. The bigger the down payment is, the lower the interest rates will be when taking a mortgage loan. Because a smaller down payment can risk your eligibility by increasing the interest rates of the mortgage. The more you give in the down payment, the less will be your mortgage loan. Thus, all the other costs and interests will be low. For example, if you initially pay a 30% down payment, your interest rates on the mortgage will drop by more than 0.5%. Another factor is your PMI, private mortgage insurance. Your down payment amount will also affect your PMI. Also, if your down payment is less than 20%, you will have to buy high private mortgage insurance, PMI, for the mortgage. Get the best mortgage rates. There are two types of mortgage rates. One is a fixed rate mortgage, FRM, and the other is an adjustable rate mortgage, ARM. Fixed rate mortgages have a constant interest rate, which you will pay over the entire loan period. The insurance and property taxes policy changes will not change your mortgage payment plan. And the interest rates will remain the same in the case of a fixed rate mortgage. On the other hand, the interest rate changes after the initial period expire in an adjustable rate mortgage, ARM. And these changes in interest rates depend on a particular criterion. But the monthly mortgage payments go up in some cases once the period is over. That is why choose the best mortgage rate that suits your need. Organize your payment history. It is better to organize your finances, payments, and income sheet before even applying for a mortgage. The earlier you do it, the better chances you have that you'll manage the transactions. Make sure to pay any leftover payments of your council taxes, utility bills, etc., because these leftover dues will cause trouble for you in calculating your credit score and your credibility for the mortgage loan. Organize your income sheet. Your income sheet will help the lenders to decide the amount of loan you should be given. And all of your income sources will be checked and judged. That is why your income sheet will eventually decide the loan amount and mortgage rates. You must have your past 6 months' payslips and bank statements from the last 3 months. This will help the lender think that you are reliable or not. And the lender can help you in making the payments on time. We love to create animated videos to help people like you. Hit subscribe and the bell icon to follow the Money Trace channel. By becoming a part of the Money Trace community, you won't miss our latest videos. One last tip, we've selected 2 other videos that will expand your knowledge even more. Enjoy!